Hey there, everyone. Welcome to this special edition of The Final Bar. It's an all mailbag edition. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, not from Redmond, Washington, but today from a sunny and very hot Columbus, Ohio. Excited to be coming to you remotely today, and appreciate your patience as we get these shows posted when I'm able to do so. It's Friday, June 21st, and I think at the end of a week like this one with a lot of interesting reversals. Great time to answer some of the great questions that we've received recently in our Final Bar mailbag. As a reminder, the mailbag is always open and it's running a little low. So what questions have you run into as you've been trying to make sense of these markets with the S&P teasing that 5,500 level, a lot of leading names showing a little bit of vulnerability this week. What are you running into in terms of technical indicators, approaches, sentiment indicators, market history, stocks and ETFs that you're thinking about? Any of that is fair game, and email is always best to get your questions to us, thefinalbar@stockcharts.com. With that in mind, let's get to question number one. Dave, in an uptrend, do you sell stocks at pullbacks or continue holding even when you see a 5% loss? You had a detailed questions that you shared with me, really going through, how do you differentiate from a pullback versus something that's really getting worse. And I will tell you, it's a common question, right? And I think with any sort of stock that's been going up. And sorry, I didn't mean to bring that up. I'm bringing like an Nvidia. When you're looking at something that's had a really good run, how do you differentiate a brief pullback versus something more significant? And I would tell you that maybe something like a CNC maybe is a good example. There we go. This is something, this is Centene. This is a healthcare provider. I actually put this out on social media earlier this week as an example of, a stock that instead of having a healthy pullback really started to deteriorate. And I would say that anytime you own a stock that's in a pretty good uptrend, it's above 2 upward sloping moving averages, as a trend follower, I think your goal should be to follow that trend as long as possible, right? And let the chart tell you when the trend may be reversing or when the conditions are starting to be less than ideal. A couple different things to think about. I mean, number one, I think as a medium-term or long-term investor, you shouldn't be buying any stock unless you're okay with a 5% pullback. That should be within the normal vulnerability of any particular trend, right? Because pullbacks happen, right? And expecting that a stock will just continue to go up with no pullbacks, that just doesn't happen. Even in Nvidia has pullbacks, as we saw this week and as we've seen earlier in 2024, but the primary trend remains positive. I think what you want to do is pay attention to what happens during the pullback phases. So Centene is a good example of a healthy pullback, which is pulling back to an ascending 50-day moving average, the RSI bottoming out around 40. That's what you saw like in the fourth quarter of last year. That was actually pretty constructive. And that's kind of the ideal scenario, right? A higher low is formed. We don't break below previous support. The RSI remains above 40 on that pullback. Those are all signs that conditions are pretty good. Look at what happened here. All of a sudden, the RSI is breaking below 40, where we're not holding the 50-day moving average. Especially here, we don't even hold the 200-day moving average. Here, instead of making higher highs, we're stalling out and unable to make new highs. The RSI on a rally doesn't get above 60. So we had all of those signs that Centene was rotating from more of a constructive phase with positive momentum, positive trend, to something with a negative trend and negative momentum. So on that pullback, I mean, there's no guarantee that it's going to be a higher low and it's going to be a buyable pullback. So anytime you buy a name that's pulling back, you are by definition taking on some risk. And the risk is that the pullback isn't a pullback, but the beginning of something worse. So I think it's less about being right all the time with those pullbacks, but more about managing risk and saying, if I am buying this pullback, what would I see on this chart, or what signal would tell me that it's not just a pullback, but something really scary, right? It could be the beginning of something much worse. Arguably, the chart of CNC gave you those signs because the momentum breakdown, because of the lack of follow through on the upside, because we failed to hold support, failed to hold moving averages. Those are the kind of things that could tell you a pullback is no longer a viable pullback. And again, investing, in my experience, is not about being right all the time. You're going to be wrong plenty. It's all about when you're right, staying right, and when you're wrong, admitting you're wrong and making a meaningful change in your portfolio. That's how I would think about those. Question number 2. I trade 3-time leveraged ETFs like SOXS and SOXL. Those are the leveraged long and short semiconductor ETFs. would you use technical analysis on these ETFs or just on the underlying ETFs? That's such a great question. And the short answer is no, I would not tend to use technical analysis on leveraged ETFs. And here's why. A leveraged ETF, what that's trying to do is basically take the daily returns on the underlying ETF. So I think for those, they're using the iShares ETF, which is SOXX. This is the underlying ETF. So I would be analyzing that. And then when you think about leveraged ETFs, when you think about inverse ETFs, when you think about options on something like the SOXX, I would say those are different ways, those are different levers you can pull to express a bullish or bearish thesis on the underlying security. So, I would not be charting an individual option and then make a trade based on the technical indicators on that option. I would not be analyzing a leveraged ETF, a triple levered ETF, and then use that to draw conclusions. Remember, those are ways of magnifying the movements in the underlying stock or ETF. So I would do my analysis on the underlying security. I would then, if you are bullish or bearish based on your analysis, then think about all the different ways you could express that, right? So if you're bullish on semiconductors, you could buy just a traditional long position in a semiconductor ETF. You could do a triple or double long ETF to magnify the potential upside returns because you have high confidence in it going higher. You could buy calls or do some sort of more exotic option strategy to express and benefit from the price going higher over a certain period of time. But I would do the analysis on the underlying stock, because for me, technical analysis is really about capturing investor behavior and quantifying that in a meaningful visual way. And the triple levered ETFs are really getting one step away from that, right? It's more derived from the underlying security. So short answer is no, I would not do the technical analysis on the leveraged ETFs. I would analyze the underlying and then use those as ways you can express your point of view on the underlying security. Next question. Dave, would you avoid a breakout below the 200-day moving average? Oh, would you avoid a breakout if it happened below the 200-day moving average? I think that's what you're asking. Or would you wait for an upward sloping 200-day? Really interesting question. I'm trying to think of something like in a primary downtrend, WBD. This is sort of my go. At some point, Warner Brothers Discovery will actually turn higher, and this will no longer be able to be my token bearish chart. This thing's just been such a downtrend. Maybe I'll diversify, look at things like Disney and others, and try to highlight it. Maybe Disney is a good example of this as well. So your question is, would you buy a breakout below the 200-day moving average, or would you wait for it to turn higher? Disney actually has all of that. If you start in sort of August, September of last year and look through like February of this year, we've gone through all of the movements, right? So step one, we're in a clear downtrend, and then we stopped making new lows, right? So September, October, November, certainly the late October low did not undercut the early October low, and that was an early sign that maybe things were stabilizing. You had an initial breakout. You actually gapped above resistance here in November. So your question is, would you be buying that breakout? Or I guess you're asking me, would I wait for a break above the 200-day moving average, or would I wait for the 200-day moving average to slope higher? Like, what do you do? So there's no perfect answer to that, and I think that answer is something you have to answer. And that's part of the reason why when I'm showing a chart on the YouTube channel here, I don't say Disney's a buy. Make sure you go buy Disney. Number one, that's sort of goes against the ethical principles that I agreed to as a CMT charter holder, not make a recommendation when I'm not authorized to do so. However, it also, I think, recognizes the fact that we all have different goals. We all have different timing, investment horizons. We have different assessments of risk versus reward. And so it's hard for me, not knowing you and your process, to say this would be a great time for you to pull the trigger. I can tell you what I tend to do, and I would say it depends, right? I have no problem with something that is in an extended downtrend taking an initial position when I see a breakout. And even if we're still below a downward sloping 200-day moving average, I never really buy new lows. That's just something I have decided a long time ago not to do. I wait for some sign of accumulation. So for me, not making a new low would be the first sort of encouraging sign on this chart. When we break above that resistance, that would be sort of a sign for me of, yeah, maybe I would take a position. So, I might, and I would say, generally speaking, that's where I would probably take a partial position, meaning if 100% of the position would be like 10,000 shares, I'm just throwing a random number out there, then maybe I would take 5,000 shares. If my plan was to own about 1,000 shares of Disney, maybe I'd take 500 on that initial breakout. And maybe I take the additional, the close out that position or take the entire position, add the other 50% when we follow through, when we break above the 200-day, when we get a MACD buy signal, some combination of things that would just validate it. So for me, that first breakout, if we're still below a declining 200-day moving average, I would think of that as an initial position. So you either take a partial position and complete it when we go further, or you can also, just use money management techniques, right? Take the position, but then really think about your downside risk. Think about where you would unwind that trade, have a good trailing stop in place. So if you're wrong, which you're going to be at some point, you minimize your losses. So you ride the potential upside, you minimize the potential downside. That's a great way to think about risk versus reward. I would say, and that was a long-winded answer to your question, I would say waiting for the 200-day moving average to slope higher often will feel very late. If you look at the chart at Disney, for example, the 200-day really didn't start to slope higher until mid-February, and that's after we'd already gone from 80 up to around 110, 112. So you're giving up a big initial gain just to wait for that point. So particularly something that's been going down for a while, waiting for the 200-day to slope higher, you might be waiting a very long time and miss out on some of those early movements. So with a lot of the technical toolkit, how you apply it, how you actually use it to inform your buy and sell decisions can be very individualized, right? Can be very specific to you, and whether you're a swing trader or a long-term position trader, you might have very different answers to which moving average you're using and what you're comfortable with in terms of taking on risk. So my main conclusion there is make sure you have a process that you're comfortable with and use it consistently. That's what's most important. Next question, on the weekly GLD chart, would you use the height of the base to identify an upside target? Interesting question. Let us bring up the weekly chart of the GLD. Yeah, you're looking at this period here. And you actually mentioned 2020 to 2022. GLD was in this range from around 190 to 195, we'll call it on the upper end, kind of 150 to 160 on the lower end. So you're basically saying this was a multi-year basing pattern. When we finally break out in Q1 of this year, can you take the height of that base as a way of projecting an upside target? And that will give you an upside target probably in like the 250s. And the answer is absolutely. That is a well sort of trodden path within the technical analysis community and in market analysis to take the height of a pattern of whatever kind and use that to anticipate the move. And that's used with head and shoulders tops and inverted head and shoulders bottoms. You will use that particular methodology with symmetrical triangles and other patterns where you have a particular consolidation range, and then you take the height of the pattern to project a minimum upside objective when we break out or a downside objective if we break down. The height of a basing pattern and using that to project levels above there, absolutely. Two common approaches with this would be, number one, kind of the basic idea would be take the height of the base or the consolidation and project that above the breakout. So however much vertical distance we had there, you project that above. The other option would be use Fibonacci retracements. We did a webcast earlier this week on Fibonacci retracements. This would be more Fibonacci extensions. So if the height of the base is 100%. What about 138%, 162%, 200%? That would be another area that I would go into. And if you want to do that on Stockcharts, by the way, make sure you use our advanced charting platform, ACP. That's where we have built-in Fibonacci extension levels in the indicators. Final question for this special mailbag edition. Is the US dollar in an uptrend? I love the simplicity of your question. You included your chart. I'm going to look at my chart here for the last couple of years. And so the answer is it depends, right? Is it in an uptrend? I mean, if you're looking at the last, month, it absolutely is in an uptrend. That's a horrible way of illustrating that, Dave. Come on. Right? I mean, if you look at the last month, right, we were going down from mid-April to early June, and now something's obviously changed, right? From that low the first week in June, we're certainly starting to trend higher. But if you look at the last couple years here, I don't know if I would say necessarily that it is, only because we're still sort of in this consolidation pattern. Level I've been looking at and been talking about is 107, because I think a push up to 107 basically still feels like we're in this big basing pattern. Think of that basing pattern we saw on the weekly GLD chart. I think it's kind of a similar thing, but We get above 107 and then we made a new multi-year high. I would say it would be impossible to describe it as anything other than an uptrend if we're able to get above there. But if you start at the end of 2023 and just look year to date, right, cover up everything to the left of that chart. Easy way to do that on stock chart, a couple different ways, but what I like to do is just draw a big rectangle, right? Cover up that action and just say, look, year to date, right, is this going up or down? I always think the Henry question. Ask my 8-year-old son, Henry, is this chart going up or down? I think Henry would say that's going up because we're making a clear pattern of higher highs and higher lows. Coming off the low from the end of last year, we have this high in February, we have higher highs, and potentially we're making our way to a new one. We're making higher lows. So based on that simple trend analysis, I would say we are. So in the very short term, we clearly are. In year to date, looking at the last 6 months, certainly appears to be in an uptrend to me. But the problem is, if you bring in more data, you can see this is, almost still within the range that we've been experiencing since the end of 2022. So maybe a little too early on. With today's gap higher, it certainly seems to be that going into next week, we'll be talking about that April peak to see if it'll be able to propel above that level. For me, 107, that's where I have this set an alert. Dollar above 107, I just don't see how that is most likely a good signal for stocks, because it will feel a lot like most of 2022, where the market was struggling. Risk assets were going down. The dollar was the only thing that was going up. That's when we called the dollar the wrecking ball for risk assets. And then that all changed in the fourth quarter of 2022. You can see the left side of the chart there, and from that point on, felt very different. And risk assets like equities had an opportunity to go higher because the dollar was no longer pushing to the upside. I think we're at a risk of a similar sort of pattern here going into the second half of 2024. That's why I'm watching the chart of the dollar very, very closely. Folks, that's it. Thanks so much for those very thoughtful questions. Please keep them coming. As a reminder, our email is thefinalbar@stockcharts.com. We'd love to answer one of your questions in our next mailbag episode. But until then, have a fantastic weekend. We should be back with a normal show on Monday, assuming we can safely travel back to Seattle on Monday morning. And look forward to seeing you then. Have a great weekend. Bye now.